how are options traded? Well, first, let's distinguish between futures and options. In futures, there's two possibilities. You can be long the futures, you can be short the futures. For options, we have four different possibilities. You can purchase a call option, you can purchase a put option, you can sell or write a call option, or you could sell or write a put option. We've already gone through some of the mechanics of purchasing a call option and purchasing a put option. With a call option, you will profit if the price of the underlying commodity rises. With a put option, you will profit if the price of the underlying commodity actually decreases. Now let's focus on the other side, which is the writing of the option. Let's first consider the call option. The example that I gave was a call option with an exercise or strike price of $200, and the underlying asset is IBM, and the share is trading for $200 today. The option has 3 months to go. Now, if I have a long position, or if I purchased the option, then as the price goes up, I actually profit. So if the price goes to $250, I've got the right to purchase 100 shares at $200. And my profit would be $50 times 100 is $5,000. Now, the other side of the option, the person that wrote the option, has to fulfill the option. So if you purchase the option, and let's say I sold the option, you've got the right to purchase 100 shares at $200. And I have to make good on the deal. So I have to hand over the 100 shares at $200. And if I don't have those shares, I have to go into the market and purchase those shares for $250 and give them to you for $200. So you can see that your profit in purchasing the option is exactly my loss. Now it might be that we don't actually do the exact trading that I suggested. That it might not be the case that I'll go into the market and buy it for $250, sell it to you for $200, and then you go and sell it for $250. We can avoid all of that by me handing over to you $50 for each share. So just a pure cash transaction. Avoid the shares entirely. But the key thing here is that my loss is your profit when you are writing an option. Now, what happens if the price goes down? Well, if the price goes down for the call option, then you're not going to exercise the option. Now notice that the writer of the option, me, doesn't necessarily profit in this case. But we've forgotten something. We've forgotten the fee, the premium, or the option price. When you purchased the option from me, you actually paid me something. And if the price goes down, I get to keep that money. Well, actually, I get to keep that money no matter what. So when I'm writing a call option, I'm betting that the price goes down or remains approximately the same. And if that's the case, I get to pocket the premium. The premium, or the price of the option, is my profit. Now, the other thing that's very important to realize is that my risk is fundamentally different than your risk. For you, you've purchased the call option. The price goes up, that's great, you profit. If the price goes down, well, you lose the price of the option. Your maximum loss, the maximum possible sustained loss, is what you paid for the option. Now, what about me? Well, it turns out that the maximum possible profit for me is the price of the option. So if the stock price goes down or remains the same, then I will have a profit of exactly the price of the option you paid me. However, if the stock starts to go up, then I can lose. And actually, I can lose in a very substantial way. And more specifically, my loss is potentially unlimited as the stock price goes up. So while your profit opportunity is potentially unlimited, my loss opportunity is potentially unlimited. So I usually give the following advice to people that are novices in option trading. Don't write options. This is also true for corporations that are trying to do quote-unquote risk management. It's always better to purchase options. It will keep you out of trouble. If you start to write options, then there's a potential for a so-called derivatives disaster. Now this also holds true for put options. Suppose that you purchase the put option and it gives you the right to sell 100 shares of IBM at $190. Well, I'm going to sell you that option and you're going to pay me some money for it. If the price goes to $150, you've got the right to sell at $190. And the person that's going to be buying is me. I have to buy those shares at $190, and then I guess I dump them in the open market for $150 and take a $40 loss. And again, we could bypass all of the actual trading of the underlying stock by me just forking over $40 times $104,000. Now, if the stock price goes up, you walk away from the put option. When you walk away, it means that my profit is guaranteed to be the price of the option, the amount that you paid me for the option contract. So again, we've got a similar situation that my maximum profit is the price of the put option. And I will realize that profit if the put option is not exercised, or if the stock moves down only by a small amount. Your maximum profit is basically $190, because it's possible that the stock price could go to zero. I've got a huge downside exposure by writing the put option. If the price of the stock plummets, can you imagine if it went to $1? I have to go buy the shares at $1 and sell them to you for $190 to fulfill the contract? So I've got a very large downside exposure. So writing put options and writing call options have much different liability characteristics as to purchasing the options. And again, let me emphasize, for the goal of hedging, it is unlikely that we would want to write a call option or write a put option. It doesn't give us the type of insurance protection that you get if you purchase a call option or purchase a put option. Now, again, we should not confuse writing a call option and writing a put option with a futures contract. The payoffs are much different. Remember, the put option, when it's written, You get some fixed payoff if the stock price goes up, and then you can have large losses if the stock price goes down. The call option has some fixed payoff if the stock price goes down, but potentially has large losses when the stock price goes up. So these do not look like futures payoffs, and I encourage you to go to the lecture note where there is a learning experience based in Java where you can actually see what the payoffs of these instruments look like. You can put a call and a put option together and combine them into a portfolio and see what the characteristics of your portfolio actually look like.